Big Brother, mainstream media, government cover-ups. You want answers? Well, so does he. Live from Austin, Texas, broadcasting worldwide, it's Alex Jones.
And that's what I want to talk with Max Keiser, commodities trading expert, inventor of the Hollywood virtual stock exchange, a model now used in many of the news systems, a real pioneer, very successful stockbroker in his own right, TV host on BBC, RT, Press TV. I mean, literally the list goes on and on. He needs no introduction. Max Keiser. Max, hearing that introduction there, I mean, I'm seeing all these signs out there where they say all over the world the signal's been given to turn the prices up. And so now there's not even an attempt, is the signaling I'm hearing, to even deny there's global currency devaluation, and that now a race has begun across the world to print as much money as possible. Is that true? Have they decided to go ahead and drop the hammer, Max Keiser?
Hey, Alex, great to be back on. Well, the propaganda is really priceless. The news is that there will be a 50% haircut on the Greek bonds. But at the same time, they announced a $1 trillion slush fund, which the president of the EU said they're going to expand on the first week to $5 trillion using derivatives. And so none of these bondholders are going to take any haircut at all. It's just a matter of moving deck chairs around on the Titanic. It's pure propaganda. The net result, as you are alluding to, is that the money supply numbers, the bailout numbers, the open spigot of the global printers is wide open. And we immediately saw the reaction in gold and silver. Gold and silver immediately have traded up sharply on the news because they realized that had there been a genuine 50% haircut, you would have seen the stock market go down and gold and silver have gone down because that would have indicated some deflation. But it's not deflation. It's propaganda covering massive inflation.
By the way, Max, let me stop you because I'm looking for the mainstream news article where they actually give the type of derivative name and admit 1 trillion leverage to 5. I'm digging around for it, but if you can, because this is breaking. And again, this morning I said, get Keiser, because I'm not a professional. I want to make sure I'm reading this right, because the headline says 50% haircut. But then it says, we're going to give you $1 trillion and then $5 trillion leveraged. And then I saw in the German parliament yesterday, they said, well, this is going to be backed up by the German pension insurance fund. So,
yeah, right. Mm-hmm. Well, the entity that's pulling the strings here is the IMF. You know, the IMF a few years ago was bankrupt itself and about to go out of business. And then suddenly, because of these bailouts, they have a new role to play. And this new role is going to be as the administrator for the people of Greece, for example. They're going to have actual police on the streets sent in by the IMF to make sure that people are paying their taxes and people are complying with these new austerity measures. And so the Greek people have lost their sovereignty utterly. And so the IMF is becoming a global banking facility, as you have warned about for many years. The global banking facilities are now being put in place. The IMF will be the administrator. The World Bank is going to be issuing some more special drawing rights, which will be another a world currency by a world bank. And so the individual sovereignty of these countries disappears. Greece will disappear. Other countries in the Eurozone disappear. And, of course, this is going to be a phenomenon around the world. The dollar itself. This is interesting, though, Alex, is that as troubling as the situation is in Europe, it's actually better than what we see in the United States. The United States dollar is really the big loser in this global game.
Okay, I want to break that down, but before I forget to ask, and now they're moving the derivatives, the 79 trillion that they admit they have, into the FDIC protected zone at Bank of America. And the word is from John Williams, William K. Black, I mean, top economist. I mean, the word is, it is truly a zombie that has run out of brains and is about to die. Well,
it's amazing because during the 2008 crisis, you had an investment a bank like Goldman Sachs, which was not considered a bank and not eligible for FDIC insurance because of the advantages they got as a broker-dealer, making a market in securities. There's a huge benefit in that. Then once the crisis hit, they said, "Oh, we're a bank." So all of our bets are now being guaranteed by the U.S. taxpayer through FDIC. Now that cycle is over, they're thinking about, well, maybe we want to be an investment bank again because we want the advantages of being a broker-dealer. We don't want to be a bank anymore. Bank of America, the same thing. They go back and forth. Merrill Lynch was an investment bank, then it's a commercial bank, now it's back to being an investment bank. Meanwhile, tens of trillions of dollars worth of bad bets that were cooked up by the bankers during the run-up to the crisis, those are now being moved from the balance sheet of Merrill Lynch, Bank of America, to the FDIC. And that means the U.S. taxpayer. And how will they pay for those bad bets? They will inflate the money supply by another 5, 10, 20, 30 trillion dollars, which means gold and silver will continue to go higher and higher as the dollar collapses and all fiat money collapses. The euro is going to collapse as well, but it's not as bad off as the dollar because within the Eurozone, you still have Germany, and Germany is the #1 export powerhouse in the world, and they are playing a very smart game about keeping the euro cheap by encouraging default in countries like Greece, at the same time boosting their exports and playing a very cozy relationship with China. And so they're playing this brilliantly. Germany's playing the best hand in the global financial currency wars right now.
All right, I'm having one of those frustrating moments because I probably had 15 articles about this today, Financial Times, London Guardian, and I didn't circle or highlight it. But I found in several articles, and I'm going to do a report on this later tonight on the Nightly News, where it actually said derivatives and gave the name of the type. Now, here in this London Guardian, they simply say they're going to take the old bonds and issue them under a new bond in new loans, but they don't give the derivative name. But actually in two of my articles, which again, I got here late, so I didn't highlight it all and I can't find it, they actually said it was a derivative. So I mean, my point is, I've been saying that this is what they would do because it's their standard playbook. Now they've done it, and I wanted to get you on to make sure I wasn't crazy, and here you are over there breaking it down. But even when we go to break, come back if you have to, dig it up during the break, because I want to give people the technicals on this because they are hiding this in plain view. I'm getting emails saying,
if you go to Bloomberg, and there's an article called "EU says 50% Greek write-down, 1.4 trillion in fund."
Okay, give that headline one more time. Bloomberg.
Yeah, go to Bloomberg. The headline is "EU sets 50% Greek write-down, 1.4 trillion in fund."
Yeah, all we need is the first part. EU sets
50% Greek write-down.
EU sets 50% EU write-down.
That's it. EU sets 50% Greek write-down.
Yeah.
That's it. That's the headline.
Guys, okay, is that Bloomberg or is that San Francisco Chronicle?
That's Bloomberg.com.
Okay, that is Bloomberg. Okay, we've got it on screen. Tell us where it's at.
Okay, you see the headline?
Yes.
Okay, go down to the end of the article. Leverage options. Under plans to be spelled out. They go into how they can leverage this fund.
Yeah, but that's what I'm telling you. I've got two articles in here that I'm unable to find where they actually name the type of derivative, and from my memory, it's a really nasty one.
Well, it's a credit default swaps, of course, are one of the prime derivatives used to move risk around the global banking system and to increase the leverage of these banks. But basically, it all comes down to accounting fraud, where they're saying that $1 trillion in fresh capital to bail out these funds, that $1 trillion has been borrowed from the IMF, effectively, and the IMF is going to borrow another $5 trillion on top of that to increase the indebtedness of the Eurozone.
Yeah, let's explain this. Not only will it devalue currency and hurt people that way, but then they're raising taxes to pay the IMF, who created the money and who created the Ponzi scheme.
Absolutely. They'll have to raise the austerity measures will be more severe to pay for this new level of debt. Absolutely.
Stay there, Max. He did give us a source. I know I've got it in mind. One of the most frustrating things when I've got just pools of papers blowing around. I'm gonna dig it out. And we're going to go over that as well. But, I mean, it even says it's derivatives. $5 trillion. And by the way, you know the U.S. has been paying for about half of this. Federal Reserve ships our money over there. So when you hear America's in debt, it's to the bankers. So we showed you that Bloomberg article where they admit derivatives, and digging through here, they mention them. I haven't found the articles yet because I read all these this morning and then didn't highlight it, where they gave the name of the type of derivative, but they admit that it is a credit default swap or the insurance on the guarantee that these bonds will be paid off. These new bonds they're issuing, to, quote, entice the Chinese to invest, they say, is 1.4 trillion. It says 1.4 trillion in one of the articles, and in the other one it says 1 trillion. And then another, it goes on to say that it will be leveraged. And again, we just went over that Bloomberg article. Here's The Guardian. Europe's leaders are claiming a victory in the Eurozone crisis after agreeing to new deals that slash Greek debt and increase the firepower of the main bailout fund to around 1 trillion euros, or 872 billion pounds. And then it goes on. Greece's debt and derivatives is, they're saying 100 billion euros. But then you notice they want 5 trillion for what? Again, they're telling us it's Greece's fault, and it's all how evil the Greek people are, but it's just like Iceland, where you've been and covered this and predicted, Max, they don't even owe anything. It's total bull. Just like we're about to have to bail out 79 trillion, backstop that for Bank of America, and when they're done with it on the news, old ladies will think they're eating dog food because it's their fault, Max.
Just increasing the debt load, okay? So if you want to understand derivatives, keep this image in your mind. Take a dollar bill and walk into a house of mirrors. And you show that dollar bill up to the house of mirrors, and you'll see, oh, my God, there's 1,000 of these dollar bills. No, those are mirror reflections of your dollar. They're not real. That's a derivative. It's the same bet on the same dollar over and over and over again. And a credit default swap, by the way, is sold as an insurance product. But there's no collateral backing a credit default swap. Therefore, by definition, it's not an insurance product. And if you have an insurance so-called product that is backstopping, 60 trillion in bank reserves, and that is obviously going to be impossible to honor if you have a systemic banking collapse due to selling credit default swaps. I did the exact same thing on Wall Street. You sell options on the market that you'll never have to make good on the options because the company that you're doing this for is about to go bankrupt. Microsoft does it all the time. They sell options on their own stock knowing that they can manipulate the stock in ways that they'll never have to honor those options. Apple Computer has done the same thing. The options market, the derivatives market, is just a huge market for fraud and for playing manipulative games. All these major corporations do it, and hedge funds do it. Now we're seeing countries do it. So now the IMF is encouraging the Central Bank of Greece and Ireland and other European countries to engage in the same fraud that we used to do on Wall Street. That's now endemic in the hedge fund industry. It's now being done on a global basis.
And they know we're waking up, so they're militarizing the police. I actually saw it in the article here, what you said. They're going to have the EU enforce the new VAT on the Greeks. Literally EU troops making sure, because the businesses are revolting and not paying it. I mean, this is really military occupation. And now we know what the TSA is trying to take gold and silver or search for it at airports, and now they're on the highways. I mean, this is a criminal takeover.
It's a banker occupation. I call it the global insurrection against a banker occupation. The bankers are occupying the economy, and they do it by imposing debt that either A, they fraudulently induce, as was the case with the mortgage crisis, and then, of course, Obama gave all those fraudulent inducers of debt immunity. They're trying to get complete immunity for all the hundreds of billions of dollars of the debt that was sold by Wall Street fraudulently, mis-selling, broke the law 5 different ways. They want a complete immunity from that.
What happens when the president gives Al Capone immunity? And, well, we'll be right back.